Welcome back, you legends. I'm Dr. Cal. Let's get right into this weekly update video. The stock market on Friday had one of the worst sell-offs that we've seen in a long while. The S&P's down 2.8%, Nasdaq nearly down 4%, and the Dow down 2%. Everything really was in the red. But if we take a look at the weekly performance, we're actually seeing mostly green, except in a few really obvious pockets, including healthcare. Tesla seeing massive sell-offs. In fact, Tesla has finally gotten down to my price target of $225. Real estate saw massive selling, as well as utilities off the heels of Hurricane Ian. And then we had consumer defensives underperforming, selling off, and financials leading. When you usually see something like this, guys, when we see energy, materials, industrials, and financials leading, it usually indicates a risk-on move. But that sell-off on Friday really mixes things up and serves as a warning shot, possibly, potentially, for things to come. Now, interestingly, the S&P 500 on the week did close in the green, but that's largely thanks to the massive outperformance of energy, thanks to the OPEC plus production cuts by 2 million barrels a day. That's 2% of the global supply that's been cut. And that production cut led to this massive rally in oil. Look at this, guys. A nearly 20% rally in just under 2 weeks. Incredible. By the way, guys, these red circles are just something that I pointed out to one of the trading community members who asked me to take a look at the chart. It's just one of the many perks that you get by joining the trading community. It's 20 bucks a month, less than 20 bucks a month if you sign up for the yearly membership, and you get access to all of my charts, all of my technicals, live real-time technical analysis every day, as well as all of my entry and exits in real time, as well as many other perks, including answering everybody's questions no matter what. One of the community members did ask about oil as a potential short, and here's my take, everybody. I would not be too excited to short oil here, but if you rode this move to the upside, this would be a reasonable take profit level here at $77. Because if you notice, guys, we had a rejection of the 125-day moving average here, another rejection right here, and we're only about $1.50 away from hitting that 125-day moving average. That production cut, yes, did help the price of oil, but in the long term, guys, as central banks all over the globe continue to raise rates, that's going to continue to destroy demand for oil and many other commodities. And really, there's no hope for oil to rally back unless we start to see the global economy picking back up and rates coming down. We're not seeing that at all. We're seeing the opposite. At the moment, guys, I'm still not bullish on oil at all. I just think that this is a counter trend rally within a much longer term downtrend that will eventually take us all the way down here. And it's right around the mid to low 60s on WTI, slightly higher than that for Brent crude oil. And so that massive rally in oil and in energy stocks, this absolutely face-ripping bear market rally, is really the only thing that saved the S&P 500 from closing red on the week. Now, I did point out something very interesting on the daily chart, guys, and it's this. I pointed out this in the trading community. And if you notice, guys, every single time we gotten really close, or we've gotten actually a completed bullish crossover on the PPO, we ended up with a pullback very soon afterwards, right? And if you notice, guys, we're now seeing the exact same thing happening again. Right here, I warned everybody, be careful, a bull trap was forming, and very unfortunately, we had that bull trap materialize on Friday with that massive sell-off. Now, the difference, guys, between either scenario, the failure of the crossover and the success of the crossover is this. When we had that failure of the crossover, we actually had a new low form. When we had the bullish crossover succeed, we had a higher low. So that's the difference. And we're now waiting to see what is going to happen. Are we going to retest the low? Are we going to stop here? Or are we going to take out the low this week as CPI, as PPI come out? Let's quickly jump to the daily chart of the SPY, the S&P 500 exchange traded fund. And I do have some major concerns that I'm going to point out immediately. One, everybody, is that we actually formed a bull pennant, a bull flag of sorts, and that broke to the downside. And that occurred after a bullish crossover. So we had a bullish crossover on the PPO, and we had that bullish structure on the candlestick pattern. And then we had this massive dump on fundamental news, on the strong jobs report, as well as on the AMD pre-announcements of the Q3 results, Q3 earnings, missing revenue by $1 billion, about 15%. And so what we had Friday is negative fundamentals overriding bullish technicals. And when things like that happen, it's very dangerous to trade the market. And that's because the only real reliable thing that we use to trade the market is technicals. And when fundamentals override technicals, we get a lot of chop, we get massive sell-offs, we get insane things happening. And this week, everybody, we're going to have the PPI, the Producer Price Index, coming out on Wednesday, right? The month-on-month PPI and the FOMC minutes, the Fed minutes coming out Wednesday. Thursday, we'll have the inflation rate as well. So we do have two major market moving fundamental news events coming up this week. And so I'll be more hesitant to read too much into the technicals, because we've reached a point this week where the market is going to move based on fundamentals and not on technicals. And we saw that Friday, right? The technicals looked somewhat bullish. We had a bull flag. We had a bullish crossover. I did warn that I did not like this really quick short squeeze. I did not like the fact that we gapped up immediately on Monday. We did not give the bears the chance to exit. We had two successive face ripping gap and run rallies, right? We gapped to the upside, we ran, we gapped again, and then we ran. And then we saw some slowdown, a bullish flag looking structure. And I simply did not trust it. I did not trust it at all. And I warned everybody, be careful, a bull trap is forming. And what do you know? We had that bull trap here on Thursday, because everybody that bought in Thursday, they got trapped Friday with that gap and crap. And so again, I repeat, the market is going to move based on fundamentals. Now, if you notice, guys, I have drawn out two scenarios that make sense to me, and here they are. Okay, so scenario number one is this green scenario, and that is that we start to form higher lows, and then we get a bullish CPI, and we have a nice rally in October, into the middle of October, hitting 390. Then we have somewhat of a weaker period towards the last third of October into November, because we'll have that November meeting on November 2nd. And then we continue to rally from there. So this is the bullish scenario. The bearish scenario is we take out this low. Okay, then we form a counter trend rally, a much weaker counter trend rally where we go back to retest 380. We fail. And then we continue to sell off all the way down to $330. Now, this scenario could play multiple ways, okay? It could play out multiple ways, one of which is we could simply retest 380 before PPI and CPI. And then if we get a hot CPI reading, we get a rejection, a double rejection here, and then we see that sell off. Another way this could play out is we could just simply chop around near this level, this green support line that I drew out. We could just chop around here, and as soon as CPI comes out, we could gap down and then start to sell off very, very violently, taking out the previous low. And so we have multiple ways where this could play out. If CPI is bullish, I expect a shallower pullback, a rally, another pullback, and a nice rally towards the end of the year. If we get a bearish CPI reading, I expect the October low to be taken out. We could potentially see a shallow rally, a bear market rally, a bear flag form, and then we will continue to see selling towards the end of October, early November. And at that point, everybody will be trading within this consolidation zone. The bottom is at 320 right here, and the top is at 359. So we've already tested the top. If we get a bearish CPI reading, we will go deeper and deeper into this consolidation zone, very likely going all the way down to fill this gap here and to the bottom of this consolidation zone. This is a very obvious pivot area, right? Because we had a gap, we had rejection here, we had another rejection. Once we broke through it, we retested again, and then we rallied. So 320 is very critical. That's likely the lowest we will see the market go to within October if we see a bearish CPI reading. Again, it will all depend on CPI. And again, everybody, I did share both of these scenarios with the trading community. Check out the link in the description if you are interested in joining us. It's $20 a month if you go for the yearly membership, and it's the best way to support me if that's something you want to do. Now let's take a look at the triple Qs. The triple Qs have been seeing significantly weaker price action than the S&P. We're now flirting with another bearish crossover on the PPO, which is again a major concern because we were supposed to form a bottom here in early October. And so if this rally fails and if we continue to see selling, this will be what we call in cycle analysis a left hand translation. Now, if you can imagine with me that this is a stock market cycle, right? This is another cycle, and then we have another cycle forming. Now, just imagine these cycles with me, okay? If we see this rally fail in the beginning of a new cycle, this is what we call a left-hand translation. And what it means is that we will have way more time for this sell-off to play out. And that very often leads to new lows forming and a very weak market. An example that I want to show you guys is this. This is a market cycle, right? We had a rally. Right after we formed the bottom here, we had a rally, and then that rally failed really early on in the cycle. The middle of the cycle is somewhere around here, and that rally failed very early in the cycle. In this example, guys, we had a very symmetrical looking cycle, right? So the cycles are improving. We had early failure here. We had failure in the middle here. And so if you are a bull, you will want to see this last cycle showing failure really late in the cycle. So somewhere in January, you want to see the market rally, and then fail late in the cycle, right? You want to see the cycles improve from a left-hand translation to a right-hand translation. That's what you want to see. By the way, guys, if you are interested in cycle analysis, you can go ahead and check out Ask Slim on YouTube. He's one of the OGs when it comes to cycle analysis. Personally, guys, I do not follow everything he does. I just like the concept of cycles. It makes sense. In no way, shape, or form is it gospel or a gold standard technical analysis method. It's just one arrow of many in your quiver, okay? So just use it as a tool. Do not get too obsessed with it. That's just my opinion. Now, with all of that being said, we do not know for sure if this is a cycle failure, or if this is a left-hand translation yet. To know for sure, guys, we need to see this low getting taken out, and then we need to see this hold as resistance. The same thing with the S&P, everybody. We need to see this hold as resistance, and then we need to see the low getting taken out. If both of these things happen on a bearish CPI reading, expect the remainder of October to be very weak. Expect more and more selling. Now let's check out the smart money indicator, the HYG, the high yield bonds. Up top is the smart money. Below in the blue and black is the S&P 500, the stock market, the dumb money. And I use this tool, everybody, to track bearish and bullish divergences. I will show you examples of bullish divergences. This is one example where the HYG, the smart money, was making higher lows as the S&P was making lower lows that led to this rally to the upside, right? Another example is right here. The HYG was making higher lows as the S&P was making lower lows, right? And that again led to the bottom in June and that nice rally that we had into mid-October, where we had another divergence, this time a bearish divergence where the S&P was making no highs as the HYG was making lower highs. And again, this signal helped us catch the top exactly right, and then we shorted all the way to the bottom, where we were able to capture 2 trades to the downside, each netting nearly 100% in profit. Okay, so these divergences are important. They're not, again, a gold standard. They're not gospel, but another tool to look at. And so far, everybody, we are not seeing a divergence, right? We had this sell-off here, everybody, without a divergence forming. And so that tells me that the market was actually bullish. Again, it was forming a bull flag. The HYG was tracking the S&P. There wasn't any divergences building. And then we had that breakdown. And so these breakdowns are very worrying because they shake up confidence in the market. They create a lot of choppy trading and unfortunately create a very messy environment for traders. And so again, guys, I do not try to catch every move to the upside and every move to the downside. I try to study the market as best as I can and go for the trades that make sense. And so it's not our job to catch every trade to the upside and to the downside. That's not our job. In a bear market, as a trader, your job is to protect as much of your money as possible. If it means making some money on the downside, that's good. But the number one goal is to protect capital so that on the other side of this bear market, when we finally get a bottom, you will have all of your capital ready at hand so you can buy in at the lows and make a lot of money. That's where the real money is made, everybody, at the bottom of the market. On the way down, yes, you could make some money, but when you start to see things like this where the fundamentals start to override the technicals, when the technicals break down, it's just a very messy time to be trading and trying to pick tops and bottoms. Now let's take a look at the VIX, everybody, the fear index, the volatility index. And again, I'm noticing something interesting here. Well, first of all, we do have this resistance line that I drew out, and then we tagged it exactly on Friday. By the way, I drew out this resistance line before the market opened, and so we tagged it exactly. And so everybody, so far the VIX has not broken out. If we start to break out and close above this black line again, and then see a close above this red line, that'll be a massive warning sign to get out of the market because more fear is coming, sharper sell-offs are coming. Be very careful if we start to see that. And again, when are we going to see that? It's going to depend again on the CPI. If we get a bearish CPI, at that point, everybody, I would not be surprised to see the VIX take out these highs. And this could end up being simply a bull flag that breaks out to the upside, giving us that final low for 2022, right? That final low at the end of October, where we could see that $320 level finally on the S&P. And then we could start to see that nice November, December holiday rally following the typical seasonality of midterm years. And again, everybody, seasonality indicates that yes, we see some rallies in early October. We could see some pullbacks, another rally, another retest and a failure, and a significant sell-off towards the last third of October into early November, right? And then we start to see that nice November rally and that nice December rally. This is an important ratio chart, everybody. This is XLY, consumer discretionary, divided by XLP, consumer staples. And we have a very clear double top formation with a bearish divergence, forming a lower low on the PPO, right? And we're now continuing to see that weakness. The PPO is still pointing down. We failed to get a bullish crossover here. And so this is looking more and more like a double top formation, and a full measured move on a double top formation that looks like this will mean another, let's take a look here, 7.7% decline in consumer discretionary in comparison to consumer staples. So consumer staples will outperform the consumer discretionary sector by more than 7% over the next little while, let's say over the next three weeks. Now again, this will depend on CPI, and at the end of the video, I will bring up a very interesting source to try and figure out if CPI is going to come in below or above expectations. Let's take a look at the 10-year yield. The 10-year yield pulled back to the 20-day EMA after having moved up insanely to the upside in this very well-defined bullish uptrend. We've now crossed down. The momentum has now crossed down, and so we could be looking at the US 10-year making a new high as the PPO makes a lower high, and that could form the top in yield for this year at least. That is still a possibility that I'm looking at, and again, it will make sense if the CPI comes in above expectations. Let's take a look at the dollar index, and again, the dollar index did the same thing. It pulled back and it's now rallying again. The PPO has crossed below, and so momentum has declined, and we do have wind at our face, but we could still see the dollar index move back up, form something that looks like a double top, at least for this year again, and then we could see that rally. I don't think that this is the top on the dollar. I think the dollar will continue to go up all the way to 120, probably by early next year. Let's take a look at gold. This is gold up top. Below is the S&P 500. And I pointed out last week that whenever we get a bullish crossover on gold, we get a nice pop in the equities market. We had that pop. We're now retesting. We'll see if that retest takes out the low again, and that will establish a new downtrend, or if we simply make a double bottom formation and we continue to rally. That will depend on the CPI. The chart above, guys, is gold divided by the S&P, and below is the S&P 500. So this is a ratio chart that again tracks risk on and risk off. And so far, gold has been outperforming the S&P 500 since, look at that, mid-August. Since we put in that top in the stock market, gold has been outperforming the S&P 500. We did not get a bearish crossover. And so again, this is warning that more downside is potentially coming and more upside in the ratio is coming. And so I did want to point out a few examples where this ratio predicted the beginning of a new uptrend in the stock market, and it happened back here when the S&P was making higher lows and the gold to S&P ratio was making lower highs. As of right now, everybody, gold has actually taken out the previous high of September 30th. So the previous low in the S&P 500 could be taken out. This is what the ratio is predicting. Again, CPI, CPI, CPI. Let's take a look at Tesla and look at this. We hit our target of 225 on the dot. We closed at 223. And I did talk a lot about this chart last week. I pointed out that the full measured move will take us down to 225. And so at these levels, guys, I'll be more hesitant to short Tesla. I suspect that will be a lot of demand in this zone. If you are short, congratulations, you made a lot of money. In fact, the position that I talked about back here, if you had held that position to Friday and then you close it on Friday, you will have made more than 2,000%. So that would have been an absolutely amazing trade for anyone that held that position. That excludes me because I did not hold that position. I actually took profits here and I did not get back into that position. So I did miss out on some of the upside. I'm still happy. I still made profits. Now let's take a look at Apple. This is Apple, everybody. And again, a full measured move on Apple will take us down all the way to $125, taking out this previous low. Right, let's take a look at Google, everybody, and again, a full measured move on Google will take us down to the high 80s, low 90s to retest this prior area of consolidation. And so, guys, we still have work to do on Google and on Apple. And if you pull up any of the mega cap stocks, you will see that we still have more work to do to the downside. Again, if CPI is bearish, we have a lot of downside targets that make sense that we will likely hit by the end of this month. Let's take a look at the CPC buy and sell signal, the put to call ratio buy and sell signal. This is a signal that I've been working on for weeks and weeks and weeks, trying to perfect, trying to iron out any kinks, and I finally figured it out. And the way to read this signal, everybody, is this. For a confirmed sell signal, we need to have the CPC 5-day moving average trading below 95. Then we need to have it cross above 95, and we need to have the PPO form a bullish crossover that will confirm a sell signal. A buy signal, everybody, we need to see the opposite. We need to see the CPC 5-day moving average trading above 1.1. Then we need to see it cross below, and for the PPO to form a bearish crossover, and that will confirm a buy signal. Now, interestingly, guys, last week we did have a confirmed buy signal in the CPC right over here on Wednesday. And there's a big but here, everybody. No pun intended. I'm noticing a couple of warning signs. The first is we need to see the slow and the fast moving averages on the PPO building distance. They need to build distance, not come close to each other, right? Another worrying sign, everybody, is this. After getting a confirmed buy signal, we need to see a follow-through day, a green day. And after a red sell signal, we need to see another follow-through day, a red down day. This past Wednesday, everybody, we did not get a follow-through signal. We got a red day and then further weakness. This could happen towards bottoms and tops. Okay, so it could simply be that the S&P is now hammering out a bottom. We will not know for sure until we get that CPI reading. So far, guys, we have a lot of conflicting technicals, right? We have a buy signal on the CPC, but we did not see price action confirming that signal. We still have a lot of work to do on the mega cap tech stocks. And then we have the HYG and the S&P moving in unison. We have yields moving up. We have the dollar moving up. And then we have the gold ratio warning of more weakness. So we have a lot of conflicting information here, everybody. And we could easily, everybody, see the CPC move back up, right? If it moves back up above 95 and then we get a bullish crossover here, that will confirm another sell signal. And very unfortunately, that will mean a whipsaw signal where we get a buy signal and then a sell signal soon afterwards. This hasn't happened so far this year. It just hasn't happened. Something similar happened to the opposite side, right? Where we had a sell signal, some weakness ahead, and then we had a buy signal. And so we haven't seen something like this as of yet this year. And this is, again, guys, due to the fact that we're trading in very, very volatile environments. The VIX is above 30, and when the VIX is above 30, the market trades based on news events. It's a news-driven market, not a technical-driven market. Now let's take a look at the fear and greed, everybody, and we're now sitting at extreme fear. I still suspect that we will go down to 0 within this month. Market momentum is weakening. Price strength is now weakening, making a new low. Price breadth is also weakening. We could be forming a double bottom. We don't know. We could still be forming a bear flag and move to the downside. The put to call ratio is down, again, ripe for a sharp sell-off. When you see the put to call ratio moving down and then beginning to curl back up, just like what we're seeing here, beginning to curl back up, that's again a warning sign that some weakness could be ahead. Market volatility, again, the VIX is now above 30 again. And again, guys, we could be seeing a triple top formation on the VIX, or this could simply be a bull flag and we move to the upside. We don't know. The market is clearly waiting for that CPI reading before making a decision to the upside or to the downside. Now, this is the figure that everybody is waiting for, and it's the CPI. This is the Cleveland Fed nowcast CPI projection, and this is the projection for September, right? Core CPI 6.64, CPI, the headline, at 8.2. And what's the market expecting? Well, it's expecting 8.2 for the headline. So that's bang on the same reading we're seeing from the Cleveland Fed. But look at this, everybody. Core CPI 6.64. The market is expecting 6.4. So that's 24 basis points above the previous reading and above the forecast. That is very worrying. So if this inflation forecast comes to fruition, the CPI unfortunately will be bearish and will likely trigger another sell-off that lasts into the end of October. Before CPI, everybody will have the PPI on Wednesday and the FOMC minutes. Before that, Monday, Tuesday, nothing really important happening. So I expect the market to continue to be weak and chop around, wait for the PPI, move on the PPI, and on the FOMC minutes, and then move again very sharply on inflation. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.